Okay, thank you very much, Viridian. Our next keynote is someone that I've got to know reasonably well. He was actually a guest on my Lend Academy podcast here just last week. Cormac Leech is probably one of the most respected analysts in this industry today. He's devoted his time to this industry probably more so than any other analyst pretty much in the world. He's got a lot of great ideas. He's done a lot of interesting stuff, and I'm looking forward to his presentation. Over to you, Cormac.
Thanks. Intro like that. That's quite helpful. Anyway, so well, first of all, thanks to Viridian for a very insightful, historic view of what's going on with marketplace lending. Apologies, but on Monday morning I am going to show you a little bit of data, hopefully interesting data. So hopefully you stay awake. So I'm from Liberum, and here we go. So is that coming up here? No, it's over there. Oh, I see. So I'm from Liberum, investment bank. We've been focused on fintech since about 2012, which actually makes us part of the early adopters, believe it or not. So today I'm going to talk about the investment opportunity as we see it at Liberum. And we start off with how big we think the opportunity is. So if we just look at peer-to-peer lending, ignore the rest of the marketplace lenders for a second, we think by 2016, in a couple of years, there will be annual volume of about $40 billion coming out from the major platforms just in the US and the UK. That's up from about 8 billion this year, so very rapid growth. In terms of yields, we expect a little bit of margin compression in the US, just as competition kicks in, just with the weight of capital coming through. Conversely, in the UK, surprisingly, we actually see some margin expansion. And up until now, and Viridian can correct me if I'm wrong, but my perception is the platforms have been erring on the side of safety, trying to avoid losing money, because when you're retail funded and you don't have lending capital with a deep understanding of what's going on, you have to err on the side of being safe. You're being compared with deposits, so you've got to really keep your loan losses very much under control. I think as institutional capital comes in, the platforms will have more confidence to take more risk, and therefore will get better risk-adjusted returns over time. So we expect the yields to actually expand a bit in the UK. I think overall, you're looking at probably about 7% yields per annum and about 40 billion of volume per annum by 2016. So quite a big prize to go for. However, the next question is, how risky is it? Obviously, not much good having a big upside if there's a lot of risk. So first of all, we're looking at consumer finance here, and the blue lines are the annual loan losses. And what jumps out at you from this, looking at consumer finance, is that really is quite a defensive asset class. Back in 2008, obviously we went through the biggest financial crisis in 100 years. Consumer finance hardly missed a beat. I mean, if you look at the top left chart, which is Zopa, you can see, Zopa's got the distinction I think Viridian referred to as one of the first peer-to-peer platforms, started in 2005. And what you can see is, and I don't know if Giles is here, but very impressive credit performance right through the financial crisis. Worst year, 2008, still returned 4.5%. To me, that's remarkable. S&P down 50%, Zopa still cranks out 4.5%. Average yields, by the way, of about 7%. So consumer finance, really not very risky, I would say. Next chart, we're looking at SME lending. So slightly more mixed picture here, actually. So again, the blue lines are the annual net returns. And if you look at the top left, you can see LendInvest. This is a secured property lender in the UK. And basically, it hasn't had a single loan loss. You can see the top left. There aren't any green bars there, which are the annualized loan losses. Since 2008, they've had 0 loan losses and average net yield of about 10%. If you look at Funding Circle, by contrast, a slightly more mixed picture. The blue lines are the net returns, so still positive in every cohort since beginning in 2010, but the mix of the green bars, the blue bars, clearly a bit more mixed. So I think with SME lending, you have to be a bit more thoughtful, but overall the returns are still manageable. So we've looked at the size of the prize, we looked at the risk. How mispriced are these loans? Put differently, what would you expect these loans to yield if they were simply traded in the wholesale market by the bulge bracket banks? One way to answer that is if you look at the securitization market. So if you look at ABS securities linked to similar type of credit risk, you can work out what you'd expect the cost of capital for these loans to be. And I won't unpack the detail, but if you kind of work out what you'd expect the yield on these to be, you find that they're yielding an extra 2 to 5% per annum. And that's quite interesting, particularly to the fixed income community here. This is excess yield of 2 to 5%. And basic economics 101 would suggest that this should erode back down to zero very, very quickly. But guess what? I mean, in my impression being in financial markets for the last 20 years, these kind of anomalies actually stick around for a lot longer than you'd expect. So we actually think, there's kind of probably 3 to 5 years of hay to be made, if you will, in terms of excess yields available in this asset class. So next chart. So here we're looking at, up until now, I've really been focusing mainly on peer-to-peer lending. However, I would advise you, particularly if you're an institutional investor here today, you've got to think equally more and possibly more about the marketplace lending opportunity. So these are the platforms, the online lenders who are taking capital, not from retail, but from institutional capital. There's some very high quality names here that frankly, to be blunt, couldn't be bothered to go to the hassle of collecting up retail money. They just wanted to get on and lend online. Some very high quality names here, definitely worth your attention. So the basic point is this is not just peer-to-peer. There's a much bigger phenomenon here, which is essentially online marketplace lending. So we've looked at how big the opportunity is, how risky is it, how mispriced is it, how sustainable do we think it is? So we decided to have a little bit of fun here and kind of try to look at a 1,000-year perspective, go back a little bit further than Ridian, just going back to the 18th century. We're going back to the Knight Templars in the 1100s. Basic point we're trying to make here is that before the internet came onto the frame, before Tim Berners-Lee invented the internet, banks really were the best way to provide the economy with a secure communication network and also the information, the credit information needed to make smart lending decisions. Guess what? Internet's come along, and it has proven itself to be a secure communication network, and there's a huge amount of credit information available online today. So the key ingredients needed for disintermediation of banking, all the key ingredients are there. So if you zoom in on the last 25 years, actually, since the internet came into place, you can see that, sure enough, you're already seeing disintermediation starting to happen, particularly on the payment side and marketplace lending. And in our view, the financial services are tracking very much the same pattern we've seen in other adjacent parts of the economy. In terms of, new entrants start to gain critical mass, incumbents start to struggle, and sure enough, we are seeing banks start to close branches today. And we think that could be the early signs of banks starting to come under real significant pressure over the next couple of decades. And no less than the Bank of England, I'm sure a lot of you here will have read the Andrew Haldane commentaries in, for example, Wired magazine, where he basically says, and this is quite controversial for the chief economist of the Bank of England, he's basically saying banking could be on the cusp of the most radical reconfiguration in centuries. It's quite a big statement to make, and you can see why CEOs are probably still in denial and shock. I mean, this is arguably a once-in-a-thousand-year event hitting the banking industry. So why does it work? Well, what's the big idea that actually has changed the game? I would say the single biggest thing that's changed is the playing field in terms of credit information has been leveled. So I mentioned earlier, the internet basically provides marketplace lenders with a huge amount of information they need to actually make smart credit decisions, to solve, if you like, the market for lemons, the adverse selection problem that exists in lending. Basically the guy borrowing the money knows more about himself than the lender. The internet now enables marketplace lenders to compete effectively with the banks. Historically, the banks have relied on their own historical proprietary credit information. There's now a wealth of information available from the likes of Experian, Equifax, FICO. If you're an online lender today, you can go to the borrower, ask him to give you permission to log into his bank account and look at his last 3 or 6 months of individual transactions. So you can start to really understand exactly what's going on with the borrower. Other innovation, if you look at Xero or Intuit, these are software packages that increasingly more and more SME companies are starting to use. And if you plug into those as a lender, you can start to get a real-time understanding of the health of each individual SME. That gives you a fantastic understanding of how the risk-reward dynamics exist for each SME lender before you extend him credit. And I frankly would be very surprised if the banks are onto this yet. So this is an example, arguably, of marketplace lenders actually being ahead of the banks in terms of understanding how to really make as good as possible lending decisions. And then, of course, you've got big data. You've got the likes of LinkedIn and Facebook. So, the other reason we think marketplace lending is sustainable is the whole efficiency theme. Ridian showed you some charts of bloated ladies from the 18th century, 1800s. We think actually the banks are very bloated. What we're looking at here is actually it's a measure of the efficiency of the banking system. We're looking at US revenues of the US banking institutions as a percentage of the intermediated assets for the last 100 years. And what's remarkable is it's flatlined for 100 years. Now that's remarkable in my view because firstly, we've had obviously huge growth in the computer industry. And also obviously we've had an information revolution in terms of the internet. So it's bizarre in my view that financial services have not become more efficient. And surprisingly, if you actually look at it as a share of the economy, the banking system has actually got bigger, not smaller. And that's really surprising. I mean, if you look at other industries like wholesale trade or retail trade, what we're looking at here is the green line is how much of their cost budget they spend on IT. What you can see is as wholesale trade spends more and more on IT or retail trade spends more on IT, the sector's share of the economy, share of GDP, decreases because you're adding efficiency gains, competition drives, the revenue pool lower. You're seeing exactly the opposite thing happening in banking, remarkably. The banks are using technology to bamboozle their clients, frankly, and actually capture more and more share of the economy. So clearly it's unsustainable. And that creates a golden opportunity for marketplace lenders. The banks are a sitting duck, frankly. The top chart is produced by McKinsey looking at Lending Club. Basically, it shows that Lending Club, apples to apples, is about 60% more efficient than the banks doing this consumer finance lending. So that creates a sustainable underpinning for the sector, at least until the banks raise their game and move aggressively into digital. And we'll talk about that a little bit later. So on the bottom part, we're looking at the fact that governments are on side. So regulators really like marketplace lending because they're keenly aware that the banks create a lot of systemic risk for the economy. So to the extent that you can take the banks out of the picture, or at least reduce their significance in the overall economy, it's very good for systemic risk. You reduce the too big to fail problem. The Treasury, the other arm of the government, if you will, it really likes SME lending because it's a way to channel credit to SMEs, credit-starved SMEs, and boost GDP growth, boost employment. So the government is on side, and that has to be helpful. Changing tack slightly, we're in the UK, so it's probably worth talking about the whole ISA phenomenon. As probably everybody in the room realizes, peer-to-peer loans are likely to become ISAble at some point next year. And to see why that's a big deal, on the top, we're comparing Zopa loans for a high-rate taxpayer in the UK versus a cash ISA. So if you're paying a 45% marginal tax rate, if you put some money into a cash ISA today, you can get about 2.4%. If the same guy puts his money into Zopa loans, after tax, he's only getting 2.2%. So, he can have the best will in the world, really think Zopa's got a bright future, but he'd be better off putting his money in a cash ISA. If Zopa loans become ISAble, all of a sudden 4% is facing 2.4%, much more compelling proposition. And we think, in broad terms, as the general public start to understand peer-to-peer better and it becomes ISAble, not unreasonable to expect maybe 10% of the ISA pool to move into peer-to-peer, and that's worth about £50 billion of balances. And just to put that in perspective, that's about a 35-fold increase in the balances in peer-to-peer. So, that's pretty explosive growth by any measure. Obviously, it won't happen in 1 year, but let's say over the next 5 to 10 years, there's a huge amount of growth likely in the UK. And it's an open question what happens to net yields. I'd be keen to hear what the platforms think, but you would think that this weight of retail capital has to compress consumer finance, peer-to-peer loans over the next few years. And if there are any bond traders in the room, I think it would be blindingly obvious trade to load up on 3 and 5 year duration consumer finance backed ABS, because I would expect those credit spreads to get very significant compression over the next couple of years. So here we're just making the point, we are in the early foothills of this progression. We did a consumer survey at Libra and we asked people, do you know what peer-to-peer is? Would you consider lending? Have you actually lend? The number is 35% of people, only 35% of people know what peer-to-peer lending is. Only 10% of people would consider lending through peer-to-peer, and only 2% of people have done it so far. I have to say, I actually think that these numbers are slightly high because we actually did this survey online. So, I suspect if you actually went out on the street and did this survey, on Bishopsgate, you'd probably get much lower numbers. So we are in the very early foothills of this. And just to look at other investment asset classes, I think there's about 50% of people in the UK have got some shape or form of cash ISA. I think about 10% of people have like an equity ISA. So if you think about risk profile of peer-to-peer lending, you might expect it to settle somewhere in the middle. So you might expect the number of people actually lending through peer-to-peer over the next few years to go from 2% or less towards something like 30%. So obviously implies a lot of growth. So, talked a lot about the upside. What do we see as the key risks? So Ridian talked about these a little bit. So the first one we see is, insufficient skin in the game. I mean, I don't know if anybody here remembers 2007 and, Bear Stearns and Lehman Brothers, cranking out a lot of subprime ABS and, basically picking up nice fees and sailing off into the sunset. I mean, there's a real risk, frankly, that we do get a disreputable marketplace lender come along, make a ton of loans, collect a lot of revenues, and then just disappear. And needless to say, over the next 3 to 5 years, that particular platform's credit risk blows up. The media have a field day, and the whole marketplace lending sector is set back 10 years. Obviously, we should try and avoid that outcome. And I don't know if you guys are fans of Buffett and Charlie Munger, but they talk about incentives. The single best way to manage risk in any situation, in their view, is to manage incentives. So, I mean, one obvious way to align incentives between the platforms and the credit risk would be to simply force the platforms to lend some of their own capital pari passu with the lending capital. And in my experience, that tends to work. Other way that can partially solve the problem is to make the CEO's compensation linked to some minimum annual net return for the lending capital. But I'm sure other people can come up with cleverer ways of doing it. But I think that alignment of incentives is really fundamental. The other key risk that we see is mis-selling risk. We think in the UK there's a real tendency for the platforms to use the mantra of let's keep it really simple so retail can understand it as an excuse, frankly, not to provide retail investors with enough information to really understand where their lending capital is actually going. I think that's very dangerous. I mean, I think a lot of the platforms existing today are very high quality management, but there's a huge risk, in my view, that you do get a new platform who sets up and makes a lot of very low quality loans, and again, we have a major problem. So we think transparency in terms of where the lending capital is going, and I would encourage people to look at Funding Circle or Prosper or Lending Club as examples of how it's possible to provide very high level of data on the type of loans we made, and I think that's absolutely vital to the industry persisting when we go through the next credit downturn. Another risk worth touching on for marketplace lenders as a new phenomenon is that the banks raise their game. So I happen to have worked at, I guess, 3 major banks, and I kind of have a deep appreciation for how slow they are in their decision making. So in theory, the banks could go, wow, this is real, we better fire half our retail employees, we better shut 2/3 of our branches, better create a special skunks work and basically develop the best marketplace lender in the world and go after this aggressively with our securitization machinery. But in practice, they won't. And so they have several issues. They have a lot of employees on long-term contracts. They have a lot of infrastructure, which they don't really know how to deal with. And the other issue is that the CEOs, the average tenure of a CEO is probably 5 years. Marketplace lending isn't really going to dominate financial services for, I would say, 10 to 20 years. So if you're a CEO, you can probably just sit back and have a nice 5 years and then frankly, go off and start your own marketplace lender. I think the banks probably won't react until it's too late. And you see that time and time again in other industries. So I talked about transparency. We think transparency is an emerging point of differentiation. If you look at some of the platforms do provide a lot of transparency. Funding Circle, I would say, is one of the most transparent platforms. Prosper is perhaps the best globally. I mean, I would defer to people like Peter Renton to tell you who is the most transparent, but Prosper seems to be very good in that respect. Lending Club, interestingly, in the last couple of weeks, seems to be becoming a little bit less transparent. But frankly, when we talk to kind of credit experts, they tell us that the data that Lending Club is no longer providing is actually not that key to making smart lending decisions. So the jury's still out there, but I think Prosper perhaps is one of the ones providing the most transparency. But we would encourage investors to discriminate based on transparency. So here we're just making the point that despite all these risks I talked about, you are seeing the smart money. I mean, if you think about who's the smart money here, it's going to be the incumbents, it's going to be the banks, former bank executives. What bets are they making? Well, guess what? They're investing aggressively in this space. That bodes very well for the sector, in my view. So how to invest? Well, I mean, we're equity guys at Liberum primarily. We do have a fund business, but primarily equity guys. And basically what we've done here is kind of tried to estimate top down on the back of an envelope, if you will, what the market cap of the sector could be 10 years from now. And we can talk about the assumptions later, but basically we get it could be about $250 billion within about 10 years. And frankly, I think that's conservative. It might be slightly disappointing to some of you that it's not bigger than that. But I think the key thing to remember is this is an efficiency play. This is about actually shrinking the revenue pool of financial services. So, we'd say there is upside to this. It's just US and UK, but about 250 billion is what we're looking at. So how to invest right here, right now? I mean, in terms of listed securities. Well, here are six securities that we kind of advise you to take a look at. 2 funds, P2P and GLI Finance. P2P I'd say is the lower risk of the two. It's got about, its target investment mix is 95% debt, 5% equity. It's only about 50% invested, so 50% in cash. We expect will be fully invested by the end of this year. Remarkably trades at a premium to NAV, and that's despite being 50% in cash. We think that premium to NAV will increase, and it goes back to the alpha I talked at the very beginning. There's about 2 to 5% pickup available in terms of the yields on these loans. As P2P becomes more fully invested, it will trade at a premium in our view because the cost of capital is less than the return on the assets. GLI Finance is the other interesting, I was going to call it a fund, but basically every time I look, Jeff Miller has done some innovation, he's done some transformational deal. This morning he just announced an acquisition of Sancus, which is a peer-to-peer offshore lender. And he tells me his mix will remain at about 30% equity, 70% debt. But I mean, GLI Finance is clearly more equity weighted than P2P and probably higher risk, higher return, but definitely one to keep an eye on. Next category, invoice finance, Bassware and Tungsten. These are e-invoice software companies that are starting to provide financing on their loans. So I'll talk about those in a little bit. Then the last category are the classic marketplace lenders, the trust buddies and the lending clubs. So Lending Club expected to IPO. Peter can probably tell you better than I exactly when, but we're hearing sometime this quarter or next. And it's expected to IPO on about 23 times 2014 revenues. TrustBuddy, by contrast, is starting to move in the same direction. It just did 2, in our view, very interesting acquisitions last week. It bought GVK in the Netherlands, which is a classic 3 to 5 year SME lender, and it acquired an Italian business, Prestiamocchi, and some of those guys are here today last week. So it's moving away from payday peer-to-peer lending towards a more classic peer-to-peer model. And we think that the valuation multiples, especially relative to Lending Club, just look too low. So, I mean, I checked this morning, it's up 5% this morning. But actually, I think that's actually a pretty smart bet for those that like to speculate. So if I turn on to the next chart, here's another kind of stock tip, if you will. I'm personally invested in this. This is Bassware. The month before last, they announced a JV with Aragras, which is a large multi-asset class hedge fund. Bassware is a leading invoice software company. And next year, they're going to do about 600 billion euros of processing of invoices. So they've announced a JV with Aragras. Aragras are going to provide financing. So if you're a supplier, essentially Bassware enables suppliers and large corporates to manage their invoices efficiently. And basically, this JV between Bassware and Aragras enables a supplier to go onto the Bassware portal, click a button, and finance an invoice. And if you look at the JV, we think that it will do about 10% of the Bassware processing volume, margin of 2%. You work it out, the JV is worth about 2 billion euros. Now, if you assume Bassware owns about half of that, that's about 1 billion euros of value for Bassware. If you compare that with the market cap of Bassware today, that implies about 75% upside. And you're getting the rest of Bassware entirely for free. So another stock tip, I think Bassware will do very well. And if we speak in the future, we check if that's correct. So finally, conclusions. I mean, I kind of leave you with 3 basic conclusions. I think it's increasingly obvious that banking does face disruption. I think to some extent you can view marketplace lending as just forcing financial services to get more efficient. It should, for example, enable the UK economy, in our view, to save about 2% of GDP every year. Maybe it doesn't sound like much, but that's about 30 billion per annum. It's quite a significant amount of money, of earnings, wealth that can be redeployed in other areas. That said, there are key risks for marketplace lending. Primary one probably being the importance of getting incentives aligned. And then secondly, it's really important, we think, for the marketplace lenders to be really transparent, to avoid kind of adverse credit event over the next few years. And then lastly, there are some listed marketplace lending securities which surprisingly are not overvalued given the outlook. So we would advise people to have a look at some of those securities we talked about. And then lastly, there are more opportunities in the unlisted space. So if any of you are interested in the unlisted opportunities in marketplace lending, please do get in touch with us at Liberum. Thanks a lot.